Let's check this out. I'm capturing this on January 29th, 2026, and what I'm about to reveal seems unbelievable. Silver has just set a new high over $120 per ounce in Western exchanges. At the same time, on the Shanghai Futures Exchange, silver reached 31,099 CNY per kilogram, equating to $139 per ounce. That's no mistake, $139 in China while it's at $120 in New York. This creates a $21 per ounce premium between Shanghai and COMEX. And this is where it becomes truly alarming. Perth Mint and Metaller, two of the globe's biggest silver refiners, are refusing all new silver purchases. None at all. Argor Heraeus and Nadir are facing major delays, with shipments delayed until April and May. Wholesale markups have surged 100 to 200% within 2 days. Per Bullion Star's announcement from yesterday, they're urgently acquiring any silver still on the market. Let's piece this together. When did you last witness a $21 gap between the planet's top 2 silver markets that no one could capitalize on? When did key mints all at once cease accepting orders? Never in documented modern market records. Not in 1980, not in 2011. Never. Based on the Shanghai Gold Exchange's daily update from January 29, 2026, silver ended at 30,891 yuan per kilogram, rising 8.51% in one trading day. That converts to $138.25 per ounce. Gold on the Shanghai futures market finished at 1,249.12 yuan per gram, or $5,590.20 per ounce, gaining 7.88%. But this figure should alert every owner of physical silver. SHFE silver stockpiles fell by 26,360 kilograms in a single day. That's 26.36 metric tons, representing a 5.2% drop in overall vault holdings in just one night. The weekly SGE silver inventory report from January 19th to 23rd indicates a reduction of 1,530 kilograms across 5 days. In yesterday's session alone, we experienced 17 times that weekly pace over 24 hours. This isn't bubbly speculation. This is actual silver vanishing from the storage network at a quickening speed while derivative markets lag behind. The current trading action is shouting that the tangible market and the futures market have fully separated. Let's discuss what a $21 premium truly signifies. In a healthy market with standard arbitrage, that disparity should vanish in hours. Traders would purchase COMEX silver at $120, transport it to Shanghai, offload it at $139, and claim the profit. That's basic arbitrage. But it's not occurring. Why? Because the real metal isn't transferring. The Shanghai markup isn't wild over-enthusiasm, it's distorted pricing in the market. And it shows that actual delivery in China commands $21 more than a futures contract in New York. Now let's broaden to the chart analysis since the graphs are backing up what the basics are yelling. Silver shattered its prior peak, stabilized, and is now in uncharted territory, moving beyond all past barriers. The volume data reveals huge buildup in the $90 to $100 zone, indicating big institutional and national buying. The 21-day average is at $97, offering strong backing far above what seemed unrealistic half a year ago. Now, let's address the genuine dangers because naive positivity can ruin you in trading. There are valid negative elements that might halt or undo this surge. First, the CME and COMEX could hike margin demands, which has historically smashed hype-driven advances. In 2011, as silver touched $49, the CME increased margins 5 times over 9 days, and silver plummeted. Second, it's unclear if Western central banks will step in with joint swaps or urgent lending. Third, this might be an explosive peak. Sharp upward spikes often conclude in harsh drops that eject 90% of late entrants. Fourth, the Shanghai premium could shrink fast if Chinese officials enforce capital restrictions. Fifth, if this upswing stems partly from automated systems, an abrupt change in market mood could spark programmed sell-offs. And sixth, we lack complete insight into COMEX storage levels or LBMA vault contents. Hidden reserves might suddenly enter the market. These are serious threats. Anyone claiming silver can only rise from here is pushing an agenda. You must assess your risk appetite, your investment timeline, and your sell plan before committing funds to any asset at record highs. But, and this is an essential however, here's why the positive outlook has grown much stronger in spite of those hazards. The Perth Mint and Metal Ore News isn't a short-term supply glitch. These are long-standing entities with strong supplier ties. For both to abruptly stop new purchases signals a deep flaw in the distribution network. Per Bullion Star's recent notice, wholesale markups have jumped 100 to 200%. That's not a brief crunch. That's a revaluation of real metal against derivatives. Argor Heraeus and Nadir are listing April to May arrivals. We're in late January. That's a 3 to 4 month delay for processed silver from Europe's leading plants. This is a core supply emergency. And here's the punchline. Mining output is basically locked in the near future. You can't simply open a fresh silver mine and start producing in half a year. Dedicated silver operations need 5 to 10 years from finding to output. Much silver comes as a side product from copper, lead, and zinc extraction. Thus, silver availability is mostly unresponsive to price shifts soon. The Shanghai storage depletion is the clear evidence. 26 metric tons in one day isn't guesswork, it's real withdrawal. It's factories, government purchasers, or major entities claiming delivery and pulling metal out of the trading framework. The Silver Institute's figures indicate worldwide silver use in manufacturing reached fresh peaks in 2024 and 2025, fueled mainly by solar panel fabrication for photovoltaics. China by itself is adding solar setups that demand hundreds of millions of ounces of silver yearly. That silver won't return to circulation. It's locked in panels for the coming 25 years. Now, let's link this to the broader economic context, because commodities don't shift independently. Gold is at $5,600 in Shanghai, up almost 8%. That's not solely a silver tale, it's a currency narrative. When gold and silver both climb with speeding vault reductions and production stops, the market is indicating eroding trust in paper money reliability. Tangible goods with inherent rarity are being repriced upward versus endless fiat notes. The Chinese regime has been methodically stockpiling gold for more than 10 years, but silver has stealthily turned into a vital resource thanks to its essential function in China's green energy shift and advanced production. China dominates a large share of global silver processing power, and they've lately stiffened export limits on key minerals, including specific silver mixes for tech and military uses. When a nation curbs outflows while local rates soar 20% over global ones, that's not trading flaw. That's deliberate stockpiling. Here's the midway disclosure that reshapes it all. That $21 Shanghai markup isn't merely a figure, it's a signal. In a realm where bots can exploit a 1-cent variance in microseconds, a lasting $21 difference means arbitrage is gone. And arbitrage fails for one cause. The core item can't physically shift to erase the gap. Silver currently can't bridge the divide because refined silver is scarce in the volumes required to meet Chinese needs at any cost the West will offer. That's not a trading flaw. That's the market indicating the futures rate in New York is imaginary. The true rate, where real metal trades in bulk, is $139 in Shanghai and rising. Bullion Star's notice stated they're eagerly seeking any silver still out there. Parse that precisely. One of Asia's top precious metal sellers is racing to locate silver, not bargaining costs, racing to secure stock. When sellers with solid sector connections are openly declaring they're searching for supply, that verifies what the Perth Mint pause already showed. The tangible market is fractured. This leads to the main query. What comes after? I can't foresee tomorrow, but I can outline reasonable paths. Path 1. This is an overblown summit. Values crash 30 to 50%. Shaky investors dump in fear, and we stabilize at $70 to $80 for half to a full year before the next climb. Path 2. We hit extended sideways movement at present values. Silver fluctuates from $100 to $130 as production gradually aligns with consumption. Path 3. The supply crunch intensifies, leading to a real scarcity where purchasers can't obtain metal regardless of cost. Values might climb much further, 150, 200, or beyond, as the derivatives market fully erodes trust. I truly can't say which path materializes. What I can confirm is that the risk-reward balance has basically changed. Half a year back, acquiring silver at $30 involved risking 16% for a chance at 50 to 100% gains. Now, entering at 120 means you face a retreat to 80 or 90, a 25 to 33% loss, for a shot at another 50% if we hit 180 or higher. The risk-reward setup is poorer at these points, no debate. For veteran holders who entered at $20, $30, or $50, this is the phase you've anticipated. But it's also the phase that challenges your resolve. Do you cash out and secure transformative returns? Do you endure the swings? Do you sell some and keep the remainder going? No one-size-fits-all solution. If you're planning to realize gains, create a strategy. Set ahead at what level or in what scenarios you'll exit. Document it and follow through. For fresh entrants thinking of jumping in now, I'll be direct. You're purchasing at record peaks with minimal safety net. If you trust the ongoing supply shortfall idea, then spreading buys over 3 to 6 months is wiser than a single big investment today. If we face a 30% dip, you'll appreciate the averaging. If we surge to 150 directly, you'll still be involved. Now let's address the big issue, counterparty exposure. If you hold derivative silver, ETFs, contracts, pooled storage, you don't possess silver. You have a commitment that somebody will provide silver under set terms. In chaotic markets where producers are pausing orders and storage levels drain 5% daily, that commitment could be worthless. If the Perth Mint isn't taking fresh business, what occurs to current pooled certificate owners wanting to switch to real metal? These are actual dangers that derivative silver owners must weigh. The same goes for COMEX contracts. In dire situations, platforms can invoke force majeure or pay out in cash. It occurred in the nickel sector on the London Metal Exchange in 2022. It might occur in silver. I'm not predicting it will. I'm noting it could. And you should recognize that possibility. Let me offer the 3 main insights. First, the real silver market and the derivative silver market have effectively split. A persistent $21 markup without arbitrage shows that value setting has moved to the physical side. Second, the delivery chain is damaged at the processing and coining stages. Perth Mint, Metalor, Argor Heraeus, and Nadir are all dealing with unmatched supply limits. This is a foundational revaluation of tangible metal. Third, storage reductions are speeding up. 26 tons in one day from Shanghai is a strong indicator that big purchasers are extracting metal from the trading network. Here's the lingering conflict. We don't know yet if Western regulators will act to curb this advance or if the real shortage will overpower any suppression efforts. Past events demonstrate that states have effectively limited precious metals surges via unified measures. But the past also reveals that when tangible deficits grow extreme, no level of derivatives tampering can suppress rates. We're in unknown waters. Perform your own research. Talk to finance experts who grasp your unique circumstances. Grasp the dangers of acquiring at peaks. Grasp the dangers of retaining derivative claims amid a real shortage. Grasp the dangers of sitting out if this marks the start of a genuine currency overhaul. No simple solutions, just compromises. What I can state is that the stats, the updates, and the trading framework all indicate a pivotal shift in the precious metals arena. Whether that shift is a crest or a springboard, we'll discover in the upcoming weeks and months. This isn't investment guidance. This is an examination of open data and market shifts. The choices you make with your funds are solely yours. Trade with reason, not excitement.